Hello and welcome to Resources 2.0 and Exploration Insider's Mining Stock Attack Plan, brought to you by Fat Tail Investment Research. I'm Andrew Gagan. Good to have you with us. Well, Australia's mining sector is again digging deep. As we come to the end of 2022, many ASX mining stocks have begun to decouple from the global indices. So are we on the cusp of another resources boom? Today, we'll hear from a veteran geologist who's explored for some of the world's mining heavyweights, and he'll give you an insider's view of the investing landscape. And we'll give you the chance to ask the experts with a live Q&A. So, if you've watched with curiosity as Aussie mining stocks have peeled away from the rest of the ASX and you want to get involved, here's your opportunity. Let me introduce our experts for today. James Cooper is an exploration geologist with international experience working with mining companies around the world, including Northern Star, Barrick Gold, as well as former copper producer Equinox Minerals and iron ore producer Crosslands Resources. He has been involved with all aspects of exploration, from very early green fields to mine development, and has explored many of the critical minerals set to play a central role in our electrified economy. And James is now the resident commodities analyst at Fat Tail Investment Research and editor for the Diggers and Drillers publication, which is an insider's take on the resurgence in mining stocks. James, welcome.
Thanks, Andrew. Good to be here.
Also joining us, Greg Canavan is editorial director at Fat Tail Investment Research and editor of its flagship investment letter, Fat Tail Investment Advisory. With more than 20 years of market experience, Greg looks out for favour and good value stocks while utilising charts to fine-tune timing and increase the odds of success. And Fat Tail Investment Research is Australia's largest independent financial publisher. It has around 150,000 subscribers and publishes investment ideas and research ranging from large caps to crypto and everything in between. Greg, welcome.
Thank you, Andrew. Good to be here.
All right, so let's set the scene. And it's if we take a look, Greg, at the strength of commodity prices at the moment, the Australian government revenue is absolutely surging. And I guess they underestimated those prices of commodities. The federal budget, therefore, is looking perhaps heading back into surplus. Is it sustainable? Are we at the beginning of a new mining boom?
Absolutely, I think we are. And just to provide some context around the reason why I think that, if you look back to the last mining boom we had, which started in the early 2000s, we're in a very similar situation now. You've got, back then you had the tech bubble that burst, the dot-com bust. US tech stocks were massively overvalued at that point. Very similar situation to what we just saw in the last 12 months. So you got a tech bubble unwinding in the US, same as what happened in 2000. Back in 2000, the Australian market outperformed the US market significantly. So you had the S&P 500 fall 50 odd percent. You had the NASDAQ fall 80% back then. Yet the ASX 200 from top to bottom from 2000 to I think 2003 only fell 23%. And I think we're entering a very similar situation now. Back in 2000, obviously the big demand kicker for resources was the emergence of China into the global economy. This time around, though, you've got a broad range of demand factors that are going to feed into the commodity sector. But the biggest thing that I think a lot of people probably don't recognise is the supply constraints that are happening all across the commodity spectrum. So when you throw in the broad demand side of things with a very constrained supply side, I think that sets us up for a secular bull market in commodities. And you just mentioned some of those bigger commodities that are feeding into the budget. Coal is a great example of that. 18 months ago, coal prices were around $60 a tonne, and they're now pushing $400 a tonne. A lot of that is to do with supply cannot respond to the increase in demand, and I think you're going to see this in a rolling type of fashion over the next 5 or so years across the whole commodity spectrum.
You say those headwinds that we're seeing at the moment are likely to unwind into 2023, and that will be bullish for commodities. However, there is, of course, the prospect of a global recession. We have a look at, for instance, oil at the moment has come off significantly. Now at its lows for the year, it's back to those prices before the invasion of Ukraine. So how is negative economic growth globally, going to affect the outlook then for commodities?
I think that the answer to that it goes back to the supply issue. So, of course, you go into a global recession, it's going to have a short-term impact on demand. But we know that recessions are relatively short-term in nature, and you get increased monetary stimulus that will come through, I think, next year. I know we've got an inflation issue that central banks are dealing with currently. But the US economy, there's a good chance it will go into recession next year. The Fed will pivot at some point, probably not as soon as the market expects, but it will pivot. And that's going to be a tailwind for the commodities sector, because purely there's a lack of supply. So when demand starts to increase again, the supply won't be there to affect it, and you're going to get rising prices. So short term, I understand there's that concern over inflation and the issues of inflation, but longer term, I think it's just a great buying opportunity.
Yeah, James, what's your view then on that, particularly as we take a look at energy and where you see some of those prices have gone now, heading into 2023?
Yeah, so again, it's that supply issue. So what really drove that was the big underinvestment after the big boom that we had in the early 2000s. So what we saw was just a big pullback in investment in those major mining companies, a major pullback in investment for small explorers. So with this sort of 10-year underinvestment in capex spending, in exploration, this is what's going to create a real sort of supply issue over the next few years. So sure, demand might taper over the next year, but it'll only take a small pickup in demand to really sort of push that ahead with the aging mines that were really sort of brought out in that last boom.
And James, I was just going to say, with the energy, the ASX 200 Energy Index has had a tremendous year in 2022, and it has not really pulled back in line with the correction in the oil prices over the past. I think oil prices come back over the past few months, especially, but the energy stocks have still been bid up really well, which just goes to show how cheap they were back in 2021. And I think even now they're still showing relatively good value, given that the longer term demand picture for them looks so strong.
And you look at coal, for instance, locally, and how that price has held up, and once again supporting government revenue. I see that in Queensland they're looking at more than a $5 billion surplus this financial year off the back of those coal prices.
Yeah, it's considering that coal is a demonised industry. There's a lot of people that are wanting to shut down coal. I know that there's coal-fired power stations in Australia. They're looking to shut those down early. But the reality is, the developing world is still building coal-fired power plants. The demand for coal it might not rise particularly quickly compared to some other forms, but it is still going to be in demand. Aussie coal is cheap to produce, and the producers will generate significant cash flows from it for years to come.
And it's a similar situation with oil and gas. The demand is still obviously there, but 2020 was actually the lowest amount of oil that was found over the last sort of 3 to 4 decades. So, and I think the year before that was 2017. So we've got record low exploration in oil and gas. So this is only going to really cause some supply issues over the coming years.
A lot of this, of course, as far as the demand side of the equation, depends on China. I'll get to that in just a moment. Before, though, let's look at iron ore. Once again, also a China-like story as to where you've seen those prices go. Because once again, it's come off. What are the drivers at the moment, James?
Well, in the short term, there's definitely, we're seeing is just reopening in China. So a reopening of slowly, or talks of reopening. So this will just be a gradual thing, I think, over 2023. And the market is obviously going to price that in well ahead of the event. And that's what we're seeing with iron ore prices and the major iron ore miners right now. So there's been a big bounce back in sort of FMG, Rio Tinto, BHP, and that's really just on the back of those talks of China reopening.
So if you're talking about a China reopening, and I mean, no one really knows because it's COVID zero policy it's a little confusing as to what they're going to do and whether they're going to stick to it, or perhaps at least, we've seen evidence that they're actually easing some of those restrictions now. How then do you look at the impact that's going to have, particularly on construction in China, and therefore that flows through to the amount of iron ore that's required?
Sure. So it's certainly, we need stimulus from the Chinese government to push that demand.
Stimulus in the property sector at the same time, because we're seeing that at the moment, aren't we?
That's right. So, and again, I think that will be a very gradual process. It won't be just an all-out sort of COVID reopening stimulus. Let's get the building back. I think it will be a very gradual approach.
Because they're slowly trying to deflate that sector too, aren't they? They're trying to get rid of a lot of the speculation in the property market, which created a destabilising, I guess, speculative environment for them that they wanted to get out of the economy. So this is going to take some time, as you say.
That's right, and also that inflation effect. So they've seen what's happened in the US. There's potential for a lot more inflation happening in China when they reopen as well.
Greg, what's your view on China, particularly from an investor's point of view, because it is difficult to read, and we hear from a lot of people, a lot of fundies and so on, are saying it's uninvestable still, until we see a turning point because of property, but also because of COVID. How should an investor look at China in that regard?
The best way to invest in China is through the commodity angle. I mean, direct investment into China, I agree, uninvestable. Xi has been very taken a hard line against the capitalists and the strength of some of their larger companies like Alipay and all those sorts of tech companies that were getting very big and powerful. They've been taken down a rung. So direct investing in China, I think, is a very difficult question. But if you want to play the China angle through commodities, and I think James would probably agree, copper is probably the number one play. Iron ore has had a tremendous run over almost the past decade. Back in, was it 2018 or 19, you had Vale essentially taken out of the whole iron ore market, which was very advantageous for our three major iron ore miners. But you probably talk about this later. There are many more. Like, I think iron ore's had its run, and there's many more commodities that Australia is number one or very top producer in, that are going to benefit from the next China run.
We sorry, James. Yep.
Yeah. No, you go. Yeah.
No, so we will get into copper very shortly, but. James, when you talk about energy with obviously constrained supply and a healthy outlook as far as demand is concerned, what other sectors are you looking at that potentially have the same sort of characteristics?
Yeah, sure. So one of the areas I do like, and it has attracted a fair bit of attention lately, and that's critical metals. So critical metals, I think most people would put with this sort of green energy transition. So that's your copper, it's cobalt, it's rare earth metals, it's lithium, it's nickel. So these are the commodities, I think, that are really going to see some strong gains over the coming years, like what we saw with oil and gas, like what we saw with iron ore. And this will be a sort of demand issue. It will also be a supply issue.
All right, so is that when you talk about a secular bull market then, and you were to pick a favoured sector, where would it be?
So this depends. So you could either look at the long term or you could look at the short term. If I was going to go short term, I would be looking at commodities that are going to be following in lithium's wake. So obviously lithium has had a very strong run in 2022. It was one of the few commodities, other than oil and gas, that performed really well throughout the year. So in looking at lithium's wake, so following in that sort of EV battery transition, energy transition, I'd be looking at sort of graphite, battery grade graphite, and probably nickel as well, as two commodities that have performed well, but they certainly haven't put on the performance that lithium has over the last year.
And how well placed is Australia in terms of reserves, but also production as well?
Yeah, so there's a couple of miners, well, near miners that I do like. The issue with graphite is that it's very much a China story. So both production and refinement of your battery grade graphite is absolutely dominated by China. So looking for alternative suppliers, there's 2 good plays in Australia, and there's also a couple of plays in Canada. Other than that, though, there's really not many options. So Australia does have a foothold. It's not dominant like it is for iron ore, but it's certainly going to benefit.
It's probably not a bad time to talk about sovereign risk, because if you want to look beyond Australia at investment opportunities in the mining space, clearly that's something you've got to contemplate, be it in Asia, Africa, South America. Greg, what are your thoughts in that regard when an investor contemplates that sovereign risk? What do they need to take into account?
Lots of stuff. And if you look at Russia right now, it's a massive commodity producer. And I'm not saying that it was the largest company that a lot of Aussie investors would be looking at for projects to invest in, but it just goes to show that if political situations change in some of these countries that are large commodity producers, and you see it in Africa a lot, your investment can be very compromised very quickly. And often a lot of those investments will trade at a big discount purely because they don't have the sovereign stability that you need, which is why Australia is so well placed, because we are, notwithstanding some of the issues over, gas supply issues and looking at quotas and caps for gas production at the moment, which is a risk. But in general, we've got a very stable country to invest in. People know that if you invest in developments, you're going to generate a return on equity that is pretty compatible with what the studies say before you make the investment. So, to me, it's a no-brainer. If you're going to invest and play on these sort of global growth themes or supply issues, Australia's probably one of the and you've got Canada and things like that as well. But for investors that are domiciled in Australia, it's just an easy way to play this theme.
Exactly.
Yeah. But of course, there are those Australian companies that have operations in those developing nations. So you say you still got to think really hard about investing there.
Absolutely, and it comes down a lot to the management team, and I think this is where expertise that James has got would suit that style investment more. I think it's very hard for people who are just looking at a stock code and saying, okay, well this company's developing a resource in Africa somewhere. I know you've worked in Africa, you understand some of the risks involved there. For someone like me, you're rolling the dice in many respects, because you just don't really know what some of those constraints are, what type of political conversations you've got to have to get development. There's lots of risks that, as an investor, I would say, look, that's just not for me.
Yeah, but particularly, I guess, it's most difficult for the explorers, because you don't know what you're getting into. A lot of it would come down to management, I guess, James, as to whether they have a track record.
That's right, and it is actually a trend we're going to probably see over the next few years as commodity prices do go up. What you tend to see in a sort of commodity-wide boom is the projects. They focus on stable jurisdictions like Australia, like Canada. But as the boom unfolds, as ground gets harder to find, you start to see some of these companies taking on more risk and going overseas. So yeah, certainly having some knowledge on where to invest. There's some African countries that I think do offer good opportunities. There's actually some Australian companies that have actually unlocked some new copper frontiers in Southeast Africa, which we can talk about later on.
All right. Well, we're going to get into copper, so we will go there. But because I noticed a note from Goldman Sachs yesterday saying that copper prices will rocket to record levels in the next 12 months as a looming supply shortage coincides with growing demand, keeping that metal in deficit into 2023. James, do you agree with that?
I agree, and I've thought this about copper for a number of years. I mean, I've spoken to Greg about this a few times. One thing that people aren't paying attention with copper is Chile, and Chile is the largest copper producer. So BHP owns the world's largest copper mine, or partly owns with Rio Tinto, and that's Escondida in Chile. And the Chilean government of late has taken a bit more of a nationalistic approach to its copper mines. It has a bit of a history of that, and increasing mining royalties and taxes. So that's really going to create a bit of a dent in investing in Chile. So that's the world's largest producer or producing
district. It's an aging mine too, isn't it?
It is. So we've got a lot of aging mines in Chile, which that means we're getting lower grades. It means we're sort of mining the fringes. It means we're putting waste material through the mill. So it's from a supply issue, copper is certainly strong.
Where are those opportunities onshore? As Greg, I mean, there aren't a lot of pure play copper companies here. Looking at BHP trying to buy Oz Minerals. You've got the likes of Sandfire, but then you have to go down to the next tier. What are the opportunities here in copper?
Well, I'll probably defer to James on that, but just I'd quickly say that the move from BHP onto Oz Minerals is all about copper, and it just sort of points to that idea that it is going to be a metal that is going to be very attractive in the future because of the supply constraints. So BHP could go out and try and find it, or they could go and buy someone who's already got a lot, and they've done the latter. So that sort of points to that. I'm not sure what's further down the rung, mate.
Yeah, that's right. You're spot on there. So there's not a lot of pure copper players available. If you were going to find one over the next 2 or 3 years, you'd really need to step into a sort of late stage explorer and sort of hope that they can bring that into production. Other than that, you really need to sort of look at sort of a gold copper play. Or even sort of a gold zinc play, and there's a copper zinc play, and there's a few of those around. Which
is probably fortuitous given where we're seeing gold go at the moment, and we're going to get to that in a moment as well. So, James, can I tap you for a couple of names where you're looking at those, the explorers that perhaps you can watch?
Gold specifically?
Or? No, for copper.
Copper. Well, it's actually a part of my monthly edition, so I better hold back on those.
You're teasing us.
Yeah, so I'll hold back on those two stocks because honestly, there really are not many options. But more broadly, I can speak about Sandfire Resources. So that's an Australian-based company, but they have operations in Australia. They also have operations in Botswana, which is a really exciting copper district. So I've worked in the Zambian copper belt. Botswana is kind of your next sort of major African copper belt, which is an exciting frontier location that Sandfire's unlocking.
All right, so I mean, we are also into the battery metals as far as copper is concerned, but also lithium. Just as far as lithium is concerned, we know how far it's run. Everyone wanted to get on. Is that over now?
For the short term, I think it is. I would be very hesitant to get into lithium right now. It is coming off a strong boil in 2022. But I'd be really looking to see prices consolidate. So we've seen Pilbara Minerals, that's really come off. IGO, after reaching historic highs just last month. November, it's really started to come off the boil. So I'd be waiting for a bit of a bottom in lithium and lithium prices.
Well, is that because there are so many different views on the demand and supply side of the equation with lithium? It's very hard for the average investor to get their head around where the price is likely to go on that basis. What is your view?
Yeah, so it depends on your investor time frame. So if you are looking at long term, I think lithium is still strong. Short term investor, I think there's stronger commodities, stronger critical metals that you could be investing in right now for the short term.
Such as?
One of them, which I mentioned earlier, would be battery grade graphite. So that's I think will follow in lithium's strong sort of performance over the last 6 months, especially when you consider that an EV battery actually needs more graphite by weight than it does lithium. And there's also a lot less producers of graphite around the world.
Well, indeed. From an Australian perspective, who are the producers?
So this was actually part of a special report that I just put out. So to be fair to my subscribers, I will hold back on that. But
all right, you're teasing us again. But if you want to go down that path, are you looking at producers or also explorers?
I think you would ideally want a late stage explorer or a very early stage producer. Early stage producer virtually don't exist right now outside of China. So you really need those companies that are looking to go into production. So maybe 2 to 3 years of production. You also have to consider that building these processing plants is going to be a very capital intensive exercise. So it's a long-term play.
I noticed that, and given your experience working with Northern Star, I see that you mentioned that Bill Beaumont, who was the co-founder, he made that switch, didn't he, into critical?
Yeah, that's
minerals?
right. It's interesting. So Bill Beaumont, he's certainly an insider. He's well known in mining circles. He's a co-founder of Northern Star. 2019, I believe, he made the switch into critical metals. Saying that though, I still believe gold can perform well. I think we'll touch on that later. But it is interesting that we have such a significant insider turning to critical metals. I think that does say something to the outlook of that of those commodities.
I was going to say, just on the point on lithium, I think that's why commodities is such an interesting place to invest in, because you can have a single commodity that goes on a run, and there was a lot of speculative momentum behind lithium this year, and for quite obvious reasons. The supply demand issue. Everyone knows that lithium is going to be high demand, and there are supply issues. The supply will come, and that'll probably push the price down. But when you get to that point where it's starting to look a bit frothy and it's a bit risky jumping on after a massive run, there's all these other opportunities you can look at in commodities. And and this is what you're pointing towards, whether it's copper or nickel or graphite, or gold or oil and gas. There's just so many different ways that you can play these booms, because even though we're talking about a general structural commodity boom that is likely in the years to come, they're not all going to move at the same time. We just saw coal have a massive run this year. That run's probably done for a while. It might stay at these levels, but the gains that you've seen in coal stocks, you can move on and look somewhere else for those types. You've just got to roll the dice a bit and say, okay, where do I think the next boom's going to come from? And that's what we're trying to look for.
Exactly, and it's just like the early 2000s commodity boom. So different commodities will wax and wane throughout that cycle. So yeah, as Greg said, lithium's run isn't over, but I think in the short term, I think we'll need to see some price consolidation.
Yeah, bearing in mind we are at the beginning of a revolution as far as transport is concerned with the move to EVs. So, and you have to look at Australia, the uptake, it's only just beginning to take off. So do you need to look much further across the horizon, not the next 1 or 2 years, but the next 10 years to see where this is going?
Yeah, that's an interesting question. And I think that definitely when we talk about the transition from oil and gas, which has been so ingrained in our civilization for the last 100+ years, I think this is not going to be a 3 or 4 year transition. Suddenly we dig up the metals and all of a sudden we're powering our global energy needs with solar panels and wind turbines. This will be a multi-decade.
It's a multi-decade move. Yeah,
Yep.
Exactly.
Yep.
So James, you were talking about, when we were talking about copper, that not a lot of pure plays there, but you can also get in on the gold miners. So obviously, copper, obviously, quite often a part of their portfolio. When you take a look at gold, and has been beaten down this year, but I noticed the gold bugs are getting pretty excited now, aren't they, as to where potentially that price could go as we see particularly the US dollar come off and bond yields fall as well. More generally, what's your outlook for gold?
I think the outlook for gold is good. I think there's definitely potential, and we're seeing some structural shifts. But again, looking back at that sort of early 2000s commodity boom and thinking about what gold prices did back then, we can really sort of get bullish again on gold as sort of the tide lifts all boats when we talk about a commodities boom. And I think precious metals will certainly be part of that as well. It might not be the best performer, but it's certainly a strong, it has strong potential to be part of an overall sort of diversified portfolio.
It has been a bit confounding this year, hasn't it? Particularly with the outbreak of war, you would think it would be a natural go-to, and also as a hedge against inflation, but it hasn't played out.
That's right, and I think if you're thinking short term, it hasn't played out, but it still certainly could play out if we think about inflation being more of a not a short term move, but a long term sticking around for a lot longer, which I think it will.
Just to add to that though, I think this is a really misunderstood thing about gold. One of the main drivers of the gold price is movements in real interest rates in the US, and we've seen real interest rates in the US in 2020 deeply negative, and they've moved into the highest they've been since around 2011, 2010, on the back of really strong bond market yield rises. So yes, inflation has come through, but the gold price is reacting to the rise in real interest rates in the US. And I think that has peaked, and I think that's going to turn down next year. Real interest rates will, because it's becoming too constrictive. When real interest rates rise that quick, it will no doubt slow the US economy. Getting into some macro factors, the M2 money supply is running negative in the US for the first time since the 1960s. So we're seeing it. We're going to see a deep monetary contraction. You've got quantitative tightening taking place. You've got the Federal Reserve over there raising interest rates at the fastest pace in decades. Gold is starting to price in, and gold moves well ahead of the actual news. It's starting to price in an easier monetary regime next year. So you're not going to see gold move up in a straight line. It's had a really strong run since its September lows, and I think there's a good chance we'll see a bit of a pullback, maybe this month, maybe next month, who knows. But if you see gold make a higher low in that correction, then I think gold is looking very, very good for the first half of next year.
Okay, so if we talk about stocks in the gold space, let's take a look at the producers. And of course, Australian companies have a good reputation in that they're very efficient. How are you rating them at the moment?
Yes, so I mean, gold, it hasn't been on my sort of short-term horizon, but as readers of Diggers and Drillers would know, I have actually, although my focus has been on critical metals, I've actually included a gold play in our portfolio, and this is based on the structural interest rates that Greg's talking about, but also just the long-term move in gold, which I think is still I think there's still a good outlook. Specific companies, I think Gold Road Resources has always been a good performer. I think that will continue.
Why is that?
I like the management team, strong management. I like the deposit. I like where it's based. Any of the gold producers based in sort of Pilbara area, I think is a sort of a new frontier for gold. And going back to Africa, I think West Africa Resources is also another has a strong outlook.
Just on that Pilbara comment, De Grey Mining, are they in the Pilbara?
That's right.
I think Gold Road have a stake in De Grey. So
that's right. Yeah. Yep. That's right. Yep.
All right. How are the explorers looking at the moment? I mean, are there a lot? Are there more coming online at this point?
Yeah, and that's a good sign for the industry that explorers are starting to come online. We're getting more IPOs, not to a silly extent like what we saw towards the end of the last boom, but I think there's a healthy supply of new exploration companies coming through. Obviously, their focus is more on these sort of green energy metals at the moment. You see a lot of these IPOs and young companies kind of transition with whatever's in favour at the time. So that's certainly nickel and rare earths and copper at the moment.
Well, just on that front, in fact, we do have a question from the audience. Any particular view on silver, given we just talked about precious metals in terms of gold, and demand, whether that will increase from green energy, the role that silver plays? Yeah,
well, that's interesting because silver does play an important part in electronics. So like copper, but certainly not to the same extent as copper. But yeah, silver does have that precious metal aspect, but it also has that industrial aspect. So it has that two-way demand fundamental, which creates a sort of an interesting outlook for that commodity.
Are there any other precious metals you're looking at the moment that have potential, I guess, particularly in that space?
Yeah, so I was looking at palladium a little while back. Prices were doing well a couple of years ago, but that's really pulled back over the last 6 months. Same with platinum, so that's that group of platinum metals. This is another one of these precious metals that you use in jewellery, but platinum is used in catalytic converters. So that has some interesting future possible dilemmas, because if we're transitioning away from conventional vehicles, possibly less demand for catalytic converters and less demand for platinum. So I think the precious metal side will still keep that commodity strong, but some of the industrial demand may start to drop off.
All right, well, just a reminder to you watching, if you do, and now's your chance if you want to get in and ask a question of our experts in regards to resources and the current outlook, and now is your chance to get on and be a part of the Q&A. Well, let's get to some of the questions. And just a broad one to begin with is asking if we want to be the supplier of critical minerals to the world, are there any signs the Australian governments, be they federal or state and territory, will move to fast-track approval processes?
Yeah, so the federal government has announced a $2 billion sort of critical metals fund. At the moment, it's given this access to, I think, 2 companies, and each one received a little over sort of 100 million. In the grand scheme of things, 2 billion, it sounds like a lot. But it's not going to be a game changer. I think where it really needs to come from is sort of the institutional investors. It needs to come from the industry. Where the government can really play a critical hand is getting into these projects early. So where they need the funding at that critical point in their development. So that's building those pilot plants for processing critical metals in Australia. So that's obviously pioneering technology, because that's mostly done in China at the moment. It's not done outside of a little bit in America, a little bit in Europe, but virtually new technology for Australia. So having government to sort of supply those critical funds at that point in a company's development could really help the industry.
Just on that front, and we've seen this in the States where the Biden administration has been active in saying we don't want China to be to corner the market just as far as rare earths and some of those critical minerals are concerned. So they're trying to encourage that development elsewhere. Some Australian companies are looking to benefit from that. How significant is that?
Yeah, I think that's a major sort of macro geopolitical issue, which will affect this green energy transition. I think the China story, I think the West is a little bit late. when we consider how long it takes to bring a mine into production, how long it takes to sort of develop these processing plants. It's good that governments and manufacturers are starting to wake up to sort of having your a one country supplier of raw materials and the risk involved in doing that. But I think there's this transition period which they'll really need to sort of fast track some of these projects, and obviously as investors tapping into some of these companies which have known deposits is a great opportunity.
All right, no surprise that we had a lithium question. Lithium producers trading at a very high PE. Is it too late to buy?
Yeah, so as I said, it depends on your short-term or long-term view. I mean, if you're looking at the long-term supply issues for lithium, it's still strong. So it's still a potential outperformer over the long term. But if we're looking at the short term, I think I'd really be waiting for prices to consolidate and really look at other commodities which have favoured lithium in the short term.
The other point to make on that is the only lithium stock that I've looked at in detail is Alchem, which is the largest one. From a valuation perspective, that's reasonably valued. So if you want to sort of move away from the more speculative end and invest in something that's a bit larger, generating revenues, cash flows, that sort of stuff, that would be the one to look at. But yeah, I agree. On the more speculative end, where the production is maybe a year or two down the track, and they're benefiting from the very high prices right now, that you'd be a little bit more cautious on those ones.
Well, I guess that potentially leads into our next question, which is, applies across the board of what's the best bet, large producers or the speckies? And I guess it depends on your investment profile, doesn't it?
It does, and I would probably, if I was sort of looking at a sort of 2 or 3 year time frame, if it was my own portfolio, I would actually be looking, sort of going halfway between. So I think your mid-cap miners are offering a great value for sort of a long-term investment. I'd be looking at those early producers or late stage explorers with known deposits, specifically critical metals right now. So yeah, I would take a halfway bet on that one and say your mid-caps. That's not to say that the early explorers don't have huge upside. So having that as part of your overall portfolio could be a good way to capitalise on the coming boom.
I would say the way to make money in explorers, just from my experience of years in investing, is to try to get in when no one's talking about it. If you're looking at a commodity because everyone else is talking about it and it's in the papers and you've seen all these lithium producer stocks or explorer stocks rise triple digits and you want a piece of that action, the chances are it's too late.
Yep.
In order to make really good money from speculative investments, you've got to take a risk. You've got to go into something where you feel a little bit uneasy because no one's gone in before you and you're one of the first ones there. You may or may not be right, but if you're wrong, you're probably not going to lose a lot of money. Whereas if you get into the speculative boom late and you're wrong, you could blow up quite a bit. So.
And sorry, Andrew. So I think this is where fund managers and analysts really are a little bit scared of the real specky stuff because it's not so much a numbers game with the small explorers. It's really comes down to geology. So you've got a small team of geologists trying to pick out targets, drill targets. So when you really do get into these small caps, you really do need to have an understanding of the ground that they hold, and just have some familiarity with the geology.
All right, well, on that point then, James, you've led us into the next question, which says successful investments in junior mining companies require more of an assessment of the management team, which you guys have spoken to, than the prospective mining area. Can you give us a cheat sheet, if you like, on on how to help with that process and what you need to look for?
Yeah, so if we're looking at managers, you definitely you want to see a sort of diversified board. You don't want specific skill sets. So I've worked for companies that only have engineers, as an example, on their board. So that means they have a very focused sort of outlook on production, but that comes at the expense of exploration. So you want to look for a management team with a proven record, but with diverse skill sets. So that's engineers, that's geologists, and that could also include an accountant or lawyer who has specific skills in the commodity sector.
All right, to the next question, which is what's more critical, a proven management team or an impressive resource? I'd imagine it's not one or the other.
That's right. So yeah, obviously you want both. Again, it depends on the size of the company. So if you have a big, if you've got a mid-cap producer, switching the land is obviously not feasible. So you need to have a good team who can bring production, can bring new projects online. When you're looking at these small explorers, I think it's more critical to have a strong team, because obviously they can filter through different projects and bring in new tenements.
And a bit of a different way of looking at it, question asking, do you look at companies that value add? It's more than just having that resource. They do some value adding at the same time.
Yeah, so I think we're talking about here with producers, rather than shipping off raw ore, but actually refining that in-house. So building the processing plants to actually sell this metal directly to market, so directly to manufacturers. And the benefit of doing that is that these mining companies can actually set up offtake agreements, so direct deals with your major tech companies. We've seen it with BHP and Tesla with their Nickel West project. And there's a lot of examples in critical metals with rare earth suppliers and lithium. It's also happening with Tesla. So that's where the real benefit comes from, being able to sort of value add your product and not just shipping your raw ore off to China for processing.
Yeah, Greg, do you see that in Australia of companies, having some vertical integration there? I mean, I guess, lithium's not a bad one, certainly as far as battery metals are concerned, in trying to capture, more of the, along the supply chain there.
Yeah, I think that's happening with, is it Lynas at the moment? I think they're developing a processing plant in WA, whereas previously they shipped it all to, I think it was Malaysia
Yeah.
For processing. And look, that's a really complex processing plant. Like, that's not an easy, and I think that's, for whatever reason, whether it's environmental or the complexity of it, it hasn't been tackled in Australia. But now I think the realisation with the criticality of these metals is that you need to have some form of processing onshore. We talked before about government assistance, and I think Lynas is another company that has received government assistance to do that, both in the US and in Australia. So maybe early days on that trend, but you probably will see more of it.
Definitely.
All right, a question just in relation to subsectors, I guess, in the resource sector, and wanting to know, as far as allocation of capital in different sectors, be it EV metals, precious metals, rare earths, as well as the producers, developers, and the size from the small end to the large end. I mean, how do you? I mean, it's a big question, but in terms of allocating that capital, what do you need to consider then?
Yeah, so that goes back to what we spoke about with commodity-wide booms. So you have this sort of waxing and waning effect of different commodities. So you'll have your leaders who will take off, like what we've seen with lithium. Then we'll have other commodities which will follow in that sort of wake. So having sort of more broad exposure over different commodities is certainly valuable if you can't actually pick which commodity is going to boom next within the overall boom. Obviously, having a mix of speculatives and sort of mid caps is adds to that as well, especially if you can do some of your own research and really get a understanding of what are some of the macro effects driving these commodity prices, and really start to sort of dig down and understand the geology in different parts of Australia or even overseas.
All right, and also a question in relation to focusing on the near-term producers or the explorers. We have gone into this, but bearing in mind the macro picture where those costs of capital are rising, how do you, when you consider that, given the economic picture at the moment, how do you assess where you should be?
Yeah, no, that's a big challenge for producers, especially critical metals, like Greg was speaking about with rare earths, and that is a highly sophisticated processing plant that Australian companies are having to design and manufacture. So it is a huge challenge. And when you talk about high interest rates and costs sort of blowing out, and also skills shortages, so labour shortages in the industry. So that's compounding that difficulty in actually building the processing plants. So it is a risk, and it's why you really need to focus on quality companies. So those companies that have something unique. So a deposit that's high grade, a deposit that may not, it's dominated by certain countries, so that's cobalt in the DRC, in the Congo. So if you can find something unique, then you know that capital is eventually going to arrive, or it gives a good chance that capital is going to arrive to develop those processing plants.
You mentioned eventually, and I think this is one thing that people need to keep in mind, is that at the moment the market is not it's not rewarding companies with heavy capital expenditure profiles in the near term, because they see it as a risk that there will be blowouts to the budget, and if you get blowouts to the budget, it's going to lower the return on capital that those projects are eventually going to deliver, which is going to affect the share price. So at the moment, you just need to be a little bit cautious about investing in companies that may have a lot of potential upside down the track, but need to go through a very heavy capital expenditure phase in, let's say, the next 1 or 2 years in order to get that, because the returns at the end of that period might not be as good as the projected forecast at the moment. So it's just something to keep an eye on. Whereas if you've got producing assets at the moment that don't necessarily need huge capex to continue producing, I think those ones are a little bit more rewarded by the market right now.
We are nearing an end to the conversation, but I did want to bring up one resource that Australia is abundant in that we haven't covered, and that's uranium. And I'll get to the analysis in just a moment, James, but Greg, interested as to whether how interested investors are in that space at the moment, given there have been many false dawns, certainly since we saw the nadir there for the industry in the wake of the Fukushima disaster. We have seen a lot of talk since then, and particularly most recently, given the energy crisis we're facing.
Well, I'm probably reasonably well placed to talk about this because I actually recommended a number of uranium stocks. I think Deep Yellow and Boss back in 2018, when I thought it was the nadir for the market, and there were some signs back at that point that the future looked very good for uranium. There was companies that were no longer selling it because they just couldn't make any money from doing it. There was a company set up on the London Stock Exchange to take uranium off the market and sit with it in an ETF type of environment because they knew it was going to rise. Unfortunately, I sold out too early, and uranium has had a very good run. I guess the critical thing for uranium, to me, it's a no-brainer that if you're looking to decarbonise your economy, that uranium has to be a part of the mix. In Australia, at least, it's a very difficult conversation to even get started from a political perspective, but my view is that the longer this transition to green energy continues, and the more that the reality dawns that renewables are not going to solve the problem by themselves. We need to talk about nuclear and uranium as being a part of that mix. And if that conversation becomes louder in the years ahead, I think that's going to be very, very bullish for uranium. So I think it's definitely worth a punt.
Yeah, James, of course, it does depend so much on the politics.
Yeah, and I think the geopolitics especially, so what we've seen in the war in Ukraine, I think is really going to help push uranium in Europe especially, just with the energy crisis. And I think policymakers have been a little bit late to understanding the vast critical metals that we actually need to build a sort of carbon-free world. So I think, as Greg says, uranium really needs to be part of the story if we're going to achieve that.
All right, well, we're almost at an end, so I'll leave the big question to last, and it is, what do you see as the commodity best to invest in currently? It's a pretty big question, isn't it? Because, look, given what we've just spoken about, yeah, clearly people, if they're going to, I guess, have one investment in the resources space, they'd like a clue. But all right, James, how do you want to approach that?
There's obviously, when we're looking at a commodity-wide boom, it's hard to pinpoint one commodity that's going to outperform. I think it's a really exciting sector to be in as an investor, and it's been a number of years that we've been waiting for this to happen. Just as a geologist or former geologist, being on the ground, seeing the activity happening in arguably Australia's main hub for mining, which is Perth, it's an exciting space. So again, it comes back to your sort of long-term, short-term horizon. I'd be looking at your sort of battery critical metals, graphite, nickel.
Yeah, beyond lithium.
Nickel,
yeah,
cobalt, yeah. And then long-term, I love copper. It's fundamental. Supply, demand, it's got everything.
Just on that point, and you've been here before as far as previous booms are concerned. You visit Perth, no doubt you've been into areas beyond, certainly in the West. How would you describe sentiment at the moment in the industry? It's
the strongest, certainly the strongest it's been since the peak in sort of around 2012. So I remember actually sort of walking down the streets in Perth 5-6 years ago, and that was in the depths of the downturn, and the streets, the CBD was just quiet. But that's changed. Perth is bustling. There's new IPOs, there's new companies. It's investor interest certainly coming back to the industry. It's a very positive time to be in mining.
Yep. Greg, you concur?
Absolutely. And I would just say, just on that other question, in terms of my favourite thing at the moment, I would say gold stocks, purely because the Aussie gold index has fallen 55% from the peak in August 2020 to the low in September 2022. And I often like to look for sectors that have had a big washout, a big bear market, and things are turning around. So from a near-term perspective, I think gold stocks are looking like the best bet for at least early 2023.
All right, well, that is the conversation. We hope you've got a lot out of it. And if you want to dig deeper, then into this discussion and James's analysis and strategy, you can head to go.fattail.com.au/dig. Well, thanks for watching, and James, thanks for joining us, along with Greg from Fat Tail Investments.
No worries. Thank you.
Thank you. Cheers.
Thanks for watching.